Ladies and gentlemen, welcome back to the channel. My name is Juliuz and I'm watching the best videos of the trading industry with you together, so you don't have to do it all by yourself. Before we get to today's video, look what I stumbled across, what got recommended to me. Making $300,000 while my wife gives birth. By Mamba FX. We watched a lot of Mamba's video in the last few weeks, so not today, but probably I need to give it a look. I need to watch this video. I just had to smile when I saw that. I just wanted to share that with you. Okay, but not today. Today we're gonna watch Craig Percoco doesn't understand statistic. Is this kind of an exposing video by Roman Paolucci? Okay, the Italians are taking over today. We are getting right into it. Let's see if this kind of an exposing video or not, what we're about to find out. I watched some of Craig's videos. He's a trader, he's trading live, so I don't know what's wrong with that. Let's get right into it. You guys leave a like and a sub really quick down below, and then let's continue here.
Nothing pisses
I need my headphones, of course. Here we go.
Off more than when math is done incorrectly. If you couple that with day trading nonsense, you have the perfect storm for me to come after you and then to clarify exactly what you mean and why it makes absolutely no sense. Today we're going to talk about this idea of a day trader's edge that Craig Percoco is talking about in the context of what he claims to be the central limit theorem. But
I think I know him. Not Craig, but what's his name again? Roman? Yeah, Roman. I think it's kind of a mathematician. I'm not sure.
We're going to get to that in a minute. Let's just go ahead and watch.
So I'm going to basically explain trading as a whole. And this is something that took several years for me to actually simply understand. And after understanding this is going to allow you to fully absorb all of the other information successfully. Starting here is going to eliminate so many issues. All right, so let's take an example of a coin flip. I want you to really think deeply about this.
Think deeply, guys. Think deeply.
I'm thinking deeply.
If I said to you that for every time you got heads, I would give you $2, and every time you got tails, I would take $1 from you. Just ask yourself right now, how much money of your own would you be willing to put into this process?
Dude, you should be willing to put everything into this process, all right? And
yeah, you can just calculate the expected value, which is, if I recall correctly, like 0.5 times 2 plus 0.5 times minus 1, and that's the expected value. I hope I still recall that correctly. And that is a positive amount of money, so on the long term you will win.
Takes no analysis to be able to come to that conclusion. All right, there's a fixed edge here. It's the law of total expectation.
So my economics degree from university was worth something.
It's the probability of your payout times the payout plus the probability you don't get your payout times what you lose. And here it's positive. That means as long as you don't run out of money, you are statistically guaranteed to accumulate infinite wealth. This is the exact same idea as a casino's edge.
And this is not how trading is working, guys. Probably won't have an edge with a 2-to-1 reward risk and a 50% win rate. You might have that, but not forever. Not until the universe ends, okay? So there will be times in which this is going against you, and if you catch the wrong period of time, you will end up losing money before the strategy completely stops working.
All right. The problem is this example is terrible because here, a coin flip doesn't change over time. The probability of a heads, the probability of a tails doesn't change over time. In the live markets, those probabilities change every single
what I was talking about
day. The probability that a contract, a product, whatever goes up or down, get out of town, changes
so depending
all
on
the
how
time.
you answer this question is going to sort of show you where you need to start off in the learning process. Trading is a game of probability and statistics, and I'm going to show you a very simple way to look at this is going to change your entire outlook. Say
a very simple way to look at it, that's incorrect.
We're doing coin flips. Okay, you'll see here we have our heads column and our tails column. So if we flip a coin randomly, we have one head. Okay, we got another tails, 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 heads, heads, tails, tails.
So a lot of trading gurus are talking about scenarios like this, like coin flips and game of probability and statistics, and then I'm wondering why they are not advertising some mechanical strategy, but rather like try to teach you to trade based off your gut feeling. Oh, if you see something like this, you might act on that, and here's liquidity and here's stuff like that. And that makes it incredibly more complicated and differs a lot from the coin example, okay? In my trading, I really try to get as close as possible to like a coin example here. I'm trying to find a mechanical strategy that is working now, that has a positive expectancy, a good statistic, and yeah, complex rules, but rules that are able to be followed every day in the same manner. Okay. that will lead to a positive expectancy over time. But we are not talking about 1-2 days or a week. We are talking about months, okay? Over 1 or 2 months, this will have a expected value that is positive. That's what I try to follow.
Tails. So right there we just did 9 flips, and you can see we have 6 times that we landed on tails and 3 times that we landed on heads. So 66% of the time we got tails and 33% of the time we got heads. So in this situation, if we lost $1 every time we got a tails, we would have lost $6 total dollars, and over here we would have made positive $6 total dollars. So in this situation, we basically made or lost no money. And say we were to flip again.
I don't know why we have to explain the coin flip here in such detail. I mean, everybody who's not basically retarded gets it at the first time that in a scenario where you win 50-50, you just have to win more on your winners than you lose on your losers. And basically that's it, but that's not, and all the gurus are talking about this as in trading terms, but this is not how it works. This is not how easy it is. Yeah, I don't know why the gurus are trying to teach you that, and you think, oh wow, yeah, if this is what trading works, I have to buy his course. Guys, that's too simple.
And we got another tails, we would actually lose money. But the reason this is important is because of a concept called the central limit theorem. And
The law of large numbers, not the central limit theorem.
once again, if this seems confusing, bear with me, because if
It's confusing because you are not presenting the correct concept.
you understand
I don't know about the concept yet, at least not by the name of it, so I don't know what he confused there.
this, you're going to understand something that most people in trading don't even consider or realize.
He's just talking about the number of executions of coin flip. Okay, so over time, over the big amount of coin flips, it gets closer to 50-50, okay? Like 10 coin flips could be a random outcome, 1,000, a little more likely to get 50-50, and with 1,000,000 coin flips, basically it's 50-50. I think this is what he talks about. Yeah, and that's, again, not at all how trading works, because in 1,000,000 executions, your strategy could be completely over the place and not working anymore.
Including you, bro.
This is showing us the distribution of getting heads on a coin flip and the frequency in which it happens over the amount of flips. You'll see here, the frequency is extremely spread out, and this is over only 5 flips. Just like
This is so boring, guys.
we saw in this example, we have 7
I guess we all heard of that 1,000 times.
tails and only 3 heads out of 10 total tosses. But if we look at these same
Okay, so there's a problem with this explanation. So first of all, it's supposed to be the law of large numbers, not the central limit theorem. Second of all, this isn't 5 coin flips, right? So if this were 5 coin flips, you would see discrete frequencies. That means you would see 1 heads, 2 heads, maybe 3 heads, right? But why are we seeing fractions of heads here? We're seeing what? 0.2, 0.1 heads? That doesn't even make any sense, because what he's actually doing is taking a what? Sample of Bernoulli trials. So he's flipping a coin, say 5 times, taking the proportion of heads, and then throwing it into a bucket on this histogram. And he's doing that a bunch of times, but not enough to actually realize the central limit theorem in effect, because we know that if we have a large enough sample size and the population, the data generating distribution is stationary, that distributions, probabilities, and statistics converge. That's not a shocker. That is what probability and statistics are in the classroom. In the real world, it doesn't work like that. Let's keep watching.
extremely spread out, and this is over only 5 flips. Just like we saw in this example, we have 7 tails and only 3 heads out of 10 total tosses. But if we look at the same exact example, out of 100 total tosses, you'll
All right. It's not 100 total tosses, though, right? Because you're taking a number of tosses, taking the proportion, and then you're plotting it, and then you're doing that again and again and again. That's the central limit theorem here. So fundamentally, he's trying to cite the law of large numbers, but chose the central limit theorem instead, and now he's explaining the central limit theorem incorrectly, right? So this is not at all...
Guys, at the end we understand what Craig is talking about. The little graphs here, the little distribution diagrams are completely for nothing. So it probably won't make you not even 1% more profitable than you were before.
Justifying his day trading edge, but if you're unfamiliar with these concepts, it sounds very sexy, like it explains everything that's going on, and it kind of makes some sense, but not really if you haven't studied probability and statistics. So this is really just a way to convince people that are ill-informed to follow this methodology. Now, to make matters worse, right, the central limit theorem and the law of large numbers are real statistical concepts, but they carry very strong assumptions that are violated in the real world. What we're going to do now is I'm just going to give him the benefit of the doubt, right? So let's say that, yes, the central limit theorem, the law of large numbers, even though he didn't cite the law of large numbers, justifies his day trading edge. I'll give him that. Let's go on over to Python, and I can prove to you...
Now it gets interesting.
...that That is incorrect. Of course, with the most basic of math. Let's start with what Craig is trying to talk about.
Okay, now let's get a little bit deeper here. I try to follow everything. Guys, keep in mind, English is not my first language. I think 60% of my university studies were in German, not in English. So I tried to follow everything here. Give me a second.
This video, and that's the law of large.
If I'm just hearing the term Bernoulli, that's not my preferred field.
Numbers. A fair coin is 50-50. That is called a probability mass function for a Bernoulli random variable. In other words, 50% of the probability is assigned to a heads, 50% is assigned to a tails. The problem is, in practice, if I only flip a coin a few times, it's not going to look 50-50. That's what you're seeing here. I have 70-30, but I've only flipped the coin a few times. Watch what happens as I flip it again and again and again, and I recompute that average. What you're going to see is, look, we converge to the theoretical probability.
Yeah, that's totally normal.
That is what it means to have distributions, probabilities, and statistics converge in the asymptotic sense in the classroom. If you take a look at this is a classic law of large numbers chart. The cumulative mean starts very poorly. It starts at 20%. And then eventually it gets closer and closer and closer to the 50. And as we flip more and more and more coins, we converge with probabilistic certainty to the true value. And it turns out if I flip a small sample of coins, say I flip 30 coins, I take the average number of heads and I plot it, and then I do that a whole bunch of times, that's a Monte Carlo simulation, I'm going to get that bell curve, that normal distribution. That is the difference between the central limit theorem and the law of large numbers. The central
Makes totally sense until this point.
limit.
Now we get to the problem of it.
Hey, Craig, your day trading edge is fully justified by the central limit theorem and the law of large numbers. I'm going to give you that. You have an edge. The problem is, in the live markets, these don't hold. And it's so easy to see. And I'm just going to use 2024 into 2025 market returns to show you this. The law of large numbers, the central limit theorem, they don't hold in the real world. Check this out. I'm going to show you now what happens if we take a sample of returns. We take the average and we try to see the central limit theorem in action.
So before we start with all of that, the question is what kind of approach Craig has that has a 2-to-1 reward risk with a 50% win chance. First of all, I'd like to see that because it's not easy getting to those numbers. Okay, really good traders might achieve those numbers. Like we saw in the previous video that Ross Cameron has about a 70% win chance with a 1.6, 1.7 to 1 reward risk ratio. So that is really good. But he's again not following a fixed mechanical strategy, but rather is just able to trade well. So it's not easy getting to those levels, and maintaining them is even harder.
The central limit theorem should produce then this bell curve. The thing is, once we get that bell curve, we're going to be able to find probabilities of events happening. Watch what happens when we get into 2025. So I'm going to assume the central limit theorem here works, the law of large numbers. We see this in action. Okay, it's starting to come in, and then bang, what happens? We get this crazy event, crazy left tail event.
At the end of March 2025, wasn't that like a little crash?
On average, how long would we have had to have waited for that event to occur? On average, according to his central limit theorem, it would have taken 1.7 million years to observe that sample mean. I don't know about you, but I haven't observed 1.7 million years of market data. All right? This is why I tell you to master your quantitative skills.
That's what I was talking about at the beginning of the video, even though I was not talking about 1.7 million years, but it is not possible to fully execute a mechanical approach with those kind of numbers forever. You just can't. At the end, we all know what Craig wants to tell us. He just wants to tell us that if you have a good approach with a 50% win rate and a good expectancy of a reward risk ratio, then you should not value each individual trade too much or too high. Over the long term, your expectancy will put you in profit. At the end, we know that you have to execute a lot of trades to really get to your expected value. This is what Roman is showing us here. And the markets are not the same forever. So at some point your edge might stop working, or the markets will change a little bit, you get a crash. Everything is possible, and you might not have the time to execute your strategy as long as needed to get to the desired outcome. It was interesting to see somebody really putting in the maths. Still, I'm not too harsh on Craig here. What he tells us is what a lot of traders tell us with the coin flip example. It's just at this point really boring to see. We heard of it 1,000 times. At some point it's enough. It's not as easy in the real market, okay? Still, I'm a big advocate of a mechanical approach. If you want to day trade something, don't get in with your gut feeling. You will have worse results, okay? Put in the time to get a decent strategy that produces a statistical reward, and then try to follow it. I think that is your best chance of winning at the markets. You might need to change your strategy over time a little bit to keep your edge. Maybe the markets are a little faster and a little more volatile. What works 5 years ago when the Nasdaq was at 15,000 or 10,000 might not work when the Nasdaq is at 30,000 like it's currently. Volatility is just different, so you might have to change some things, some settings for your approach to still work. Nevertheless, following a mechanical strategy, following statistical rules is your best chance to do it, even though if Roman is maybe telling you that it won't work at all because the markets are random. This is what we learn in university. Markets are efficient, and they are efficient over time. So you have to basically build some rules around that to kind of have a chance to go against this efficiency, okay, and to make it inefficient. So in situations where the market changes and clears up a previous working approach to make it efficient again, you have to change immediately and change some settings so you can profit on the changed markets again as well. So that is my take on that. Thank you for watching. Today a little bit more on the technical side. Next time maybe we just watch making $300,000 while my wife gives birth. That is a little bit more entertaining probably. And then I wish you a great rest of the day and good luck with trading. Bye bye.